Welcome to Montaka's Spotlight Series podcast. I'm Jessica, and today we're diving into one of the most hotly debated tech stocks today. The narrative around Salesforce over the past few months has been grim. SaaS is dying, agents will bypass software entirely, and the seat-based model is essentially finished. It's a compelling story, but in our view, misses some really important points. In this episode, Montaka's Chief Investment Officer Andrew Macken presents our case on Salesforce at the MOI Global Wide-Moat Investing Summit. Andy shares how Salesforce's competitive advantages from its proprietary data, trusted enterprise distribution, and scale have little to do with the SaaS. And as agentic AI adoption inflects, those advantages become more durable, not less. Now over to Andy.
What I want to do today is weigh in on one of the most topical debates, I think, in markets this year, and that is whether or not SaaS is dead. And what I'll do is paint a vision for one of the world's mission-critical enterprise SaaS platforms, Salesforce, in which it leverages its existing position within over 150,000 corporate customers to essentially distribute third-party intelligence in a way to actually solve problems and unlock real value, especially through labor efficiencies inside organizations. And so when you think of Salesforce as a privileged distributor rather than just a creator of code, you can start to see a world in which Salesforce thrives. And in this world, Salesforce is completely undervalued today. So that's what we're going to explore. Let me just start by giving a really brief background on Salesforce with a little bit of a basic history shown on the chart. Salesforce is by far the world leader in customer relationship management, or CRM, cloud-based software, and it's something like 4 times or 5 times larger than the number 2 player. Essentially, Salesforce houses all the data, metadata, and workflows associated with company customers, interactions, sales team processes, customer support, case management, etc. They also own Slack as a key interface layer for all of their services. And then, of course, over the last couple of years, Salesforce has really leaned into integrating LLMs and agentic capabilities into their offerings, which they're calling Agentforce. And we'll talk more about this in a few moments. So in terms of this presentation, what I want to do is just step through 4 themes. So the first is bears have declared the death of SaaS, including Salesforce. Number 2, Salesforce substantially solves the difficult deployability problem, and we'll argue that distribution is Salesforce's key moat and the hard thing for others to replicate. Number 3, tokenomics are fast becoming a major customer consideration. And we'll talk about the pricing power of foundation model companies and whether or not models are commoditizing. And then number 4, we'll argue that Salesforce appears well-positioned and misunderstood. And we'll lay out how we are framing the investment opportunity that we see in Salesforce today. Okay, so let's first talk about the death of SaaS. And I'm sure, as all the listeners will know, in recent months, advances in agentic AI from Anthropic and others have really captured the market's imagination and created a lot of fear. And this, of course, is the SaaSpocalypse, the SaaSpocalypse narrative. So, the ideas follow that, coding agents are so good that software can now just be copied or insourced or recreated quite easily. The arguments can be extended to say, well, agents will eventually become so good that they'll perhaps bypass the need for traditional software entirely, and even the humans that use the traditional software. To the extent that's true, then the death of the seat-based SaaS model will exist because we won't need as many humans. And, you can extend the argument to say that perhaps foundation model companies will essentially take over most industries. And so what that's done is that's caused a whole lot of software stocks to sell off quite significantly, including Salesforce. And so you can see in this chart, Salesforce has basically seen its shares halve in value over the last little while. And so it's interesting to reverse engineer what's priced in to Salesforce at these new low levels. And so at this level, the stock is pricing in revenue growth of only about 1% per annum. Now that's assuming that Salesforce is a going concern. I guess you could recut that and say the market is assuming a higher rate of growth for Salesforce for a period of time, but then it discontinues. It just literally ceases to be a going concern and just goes out of business. That would be another way to cut this. Another metric, the enterprise value to annual gross profits, it's 4.5 times today. It's interesting to note, just by the way, in the 2000 dot-com bubble, when Cisco, went from peak to trough, 90 something percent decline. When it bottomed, it bottomed at 5 times enterprise value to gross profit. So Salesforce is already below that level today as a starting point. And then another metric you can sort of think about is you say enterprise value to the gross profit of the backlog that's already been signed. So there's a $70 billion backlog, which is already on the books today. And that's, you can assume some sort of gross margin there of, around 75%, something like that. And you can look at the ratio of the enterprise value, which is about $160 billion today, and divided by the gross profit of that backlog, and it's down at 3 times. And by the way, that does not include any agentic consumption, which is the piece that's growing very rapidly. So those are a few metrics of what's priced in today. We'll come back to that at the end of the presentation to talk about valuation, but that's really just setting the scene. Okay, so now let's talk about the deployability problem, which we think remains underappreciated and really goes to the heart of Salesforce's distribution advantages. So it turns out that deploying AI agents safely inside an enterprise is much harder than it looks. And it isn't about agents being particularly difficult to define and run. That's really the easy part. It's actually about creating the right environment for the agents to run. So enterprises really need to think very carefully about things like governance. So, for each agent that you define, what data sets can the agent access and with what permissions? What tools can the agents use? You need to think about security. This is a really big one, by the way. It turns out that the nature of AI models is not really what most people think. And there's just extraordinary AI safety research. I encourage everyone to kind of go down the rabbit hole within. This safety research shows that AI models actually can show situational awareness and can actually deliberately deceive users. The safety research shows that AI model guardrails can actually never be foolproof. And it also shows, for example, that malicious backdoors can be hidden in AI models undetected. So a whole bunch of considerations to think about there for enterprises. Things like transparency, you've got to be able to, audit what each agent is doing and why it did it. You've got to have real-time visibility into what's going on. Reliability, as we all know, AI models produce probabilistic outputs, not deterministic outputs. That's suitable in some use cases and sort of really not suitable in other use cases. Things like control, like can you remotely shut down an agent if it goes rogue? Can you do that in real time? And then even just measuring the ROI, like the true total cost of an agent and relative to the value that's unlocked, that's not a trivial task either. So all of this says that really it's the distribution of intelligence into the enterprise that is very, very difficult. And that enterprise agentic deployments are probably going to be slower than the prevailing market narrative might suggest. And when we interview enterprise customers, which we do all the time, this is exactly what we're seeing. Okay, so now through the lens of trusted distribution, we would argue Salesforce has an enormous competitive advantage. So they already have secure, trusted distribution into about 150,000 corporates around the world. And so this can be thought of as a valuable distribution pipe through which agentic capabilities can be infused into existing workflows to unlock value. So what you can see on this schematic from the company, on the bottom layer are the LLMs that power the agentic capabilities. But the value unlock for the enterprise customer really stems from the combination of the agents with the existing software tools, data, metadata, and customer workflows. And then just building on this more recently, Salesforce has enabled headless access. That's what they're calling it. Headless access to this capability, which is to say this combination of Salesforce tools, data, metadata, and agents can be accessed by third-party interfaces such as Microsoft Teams or through Claude or through Zendesk, etc., which really makes it look like a true platform in our view. So through this lens, we would argue that Salesforce's competitive advantages have very little to do with its SaaS. And instead, the valuable things that Salesforce has that others cannot easily recreate are, number one, data. So, more than 250 petabytes of proprietary customer data and the associated metadata that provides context needed for agentic capabilities. Number two, distribution. So already established, trusted and secure distribution into the world's enterprises, as we've discussed. And then three, scale. So, the world's largest CRM-focused R&D is what takes place within Salesforce, and they, of course, are also leveraging the latest AI development tools and the largest data sets. So this third argument's a bit more subtle, but really there isn't another customer out there. Sorry, there isn't another company out there, I should say, that is spending, more than $6 billion each year in R&D, which is solely focused on improving customer sales and service workflows. So I think that's a real advantage as well. Okay, what I want to do next is just briefly provide some important additional context on token economics, which further support the hypothesis that distribution into the enterprise is the scarce resource, not the AI models themselves. So I'm sure we've all heard of token budgets being increasingly scrutinized by corporates of late. So a few headlines there, I'm sure you've all seen. So what's going on here? Well, the first thing to understand is that the compute intensity of agentic use cases is not just higher than your typical chatbot use cases. It's like hundreds of times higher. And so what you can see on this chart, if you just go from top to bottom and just different use cases, starting, well, third one down is just your chatbot, chatting to Claude or Gemini or ChatGPT, whatever. Then you can go down image generation, music generation. And then if you had like a pod of agents, then you can go down even further, video generation, world simulation, drug discovery, etc. But the key thing to understand is that as you go down with these use cases, the compute intensity of these tasks increases exponentially. And so that has, real implications for demands on compute and electric power as well. And just on this point around electric power, obviously electric power is the lifeblood of compute. And it just turns out that expanding electric power in the US right now, as I'm sure many understand, is really, really difficult. So there are really significant bottlenecks hindering expansion of US electric power, whether it's, very long multi-year queues to connect your generation capacity into the grid, whether it's, enormous local permitting delays or long lead times to actually get the kit. So lots of issues, and increasingly there are political issues as well. So just, quick sidebar on that. I mean, the situation in the US is that, electricity prices have gone up by, more than 30% since 2020, since COVID, and seem to be accelerating more recently. And this is obviously at the same time that there's an affordability crisis, I mean, as there is in many countries around the world. There was also an interesting poll published by Quinnipiac University a couple of months ago. Basically said the percentage of Americans that think AI will do more harm than good in their day-to-day lives That's up to 55%, and that's increased from 44% 1 year ago. So basically, it says it's not only really hard to expand power capacity in the US today, but it's about to get even harder. So, look, why does any of this matter and what's it got to do with Salesforce? Well, if you think about just a really crude and simplified stack, and excuse me if it's not, exactly right, but just keep it simple. A simplified stack that, customer sales and service workflows sit on, which is shown in the chart. The obvious thing within the stack, which looks both easily substitutable and which can lead to significant cost savings, is the AI model itself. There are open weight models out there that are almost as good as the frontier models, which are like 100x cheaper. And increasingly, for those who kind of follow this space really closely, increasingly you're hearing a lot of noise from a lot of customers that they are looking to substitute some of the, big brand name frontier models with, cheaper, smaller, open weight models to save on costs. And then if you consider, on this chart, the ingredients that Salesforce brings, they include established, trusted, secure distribution, integration with existing customer workflows and tools, the required data and metadata that provides the LLMs with the context that they need to actually work well. These are all, in our view, these are all much less substitutable. And so this is why we see decent probabilities that Salesforce thrives in tomorrow's new agentic world, which is absolutely the opposite of what the market consensus is right now. Okay, so now what I want to do is just wrap up with the final section by framing the investment opportunity that we see in Salesforce today. And first of all, it's important to note that we've heard a lot of real evidence of practical success in the field from many customers we've interviewed. There's just a couple of examples on the slide, but we've talked to a lot of customers who are finding success. We're seeing very high ROIs from labor substitution, and this is as simple as thinking about the costs that you're saving from reduced labor relative to the incremental spend that you're spending with Agent Force. Very high ROIs, 5x, 10x, 20x. So that's meaningful. We're also seeing across the board plans for increased customer spend, and sometimes quite significantly increased customer spend with Salesforce on the horizon, which is overwhelmingly driven by agentic consumption. And this is even net of some license reductions as labor is rationalized. So you would expect some licenses to be cut. Furthermore, on the Salesforce side itself, disclosure that they make of the tasks that are completed by customer agents, and they call this metric the Agentic Work Units, or AWUs. They're really going parabolic, as is customer token consumption. So, this is just further evidence that customers really are adopting Salesforce's agentic offerings. But of course, you'd be right to point out that, well, Salesforce's revenue growth has been pretty sluggish, especially over the last couple of years. So what's going on here? Well, we would highlight a couple of things. The first, I think, is this deployability issue that we've discussed. It really does take time. And so a lot of customers that we've talked to, they've been working on this deployability issue for multiple years now, and are only just now kind of getting, experimental use cases deployed into production. So it feels like it's only just beginning now, but it's taken a couple of years to actually get their internal environments set up to be able to handle this safely. But also number two, we point out that Salesforce has given huge discounts to drive adoption over the last couple of years, and these will roll off over the coming months. So for instance, there's an example on the slide here of a major US bank who basically said that, Salesforce has waived all of their consumption-based pricing until 2027. So it's just to get them, up and running. In this case, the bank is seeing really significant ROI. And, in this particular interview, the person at the bank was asked if, they would ever look to rip out Salesforce. And he just sort of laughed and said, no, not a chance. He basically said that for their relationship with Salesforce, it's not just about, the tech itself. It's about the long-term trust and relationship they have, and, that's built up over many decades. Data privacy, regulatory compliance, risk management, all those other things, which really feeds into kind of the deployability arguments that we've been making throughout this presentation, and just how they are so important and underappreciated. And it's through this lens that it's the distribution that Salesforce provides, which is its core competitive advantage. We put this all together, and we see a story that might look something like the following, something like what is shown on this chart right now. So on the revenue side for Salesforce, we have a mix of, on the one hand, low growth in seat-based licenses. So that's the navy blue bars on the left. So this is essentially, for the seat-based licenses, you've got a mix of, ongoing pricing power, but it's offset by the fact that you've got increased labor rationalization within customer organizations. So, pricing might continue to rise, but you've got fewer licenses. And so you sort of end up with this kind of a low growth, a seat-based license situation. But then this is offset by the pink bars, which is, very strong growth in agentic consumption. And of course, this agentic consumption is doing the work of all of the labor that has been rationalized. And then, so then you go to the middle chart and you say, right, so on the margin side, what's happening? You say, well, we would expect to see a little bit of gross margin erosion as tokens are purchased from foundation model companies, by Salesforce on behalf of customers to undertake all the agentic capabilities. But then we see an enormous opportunity to leverage, the $15 billion that Salesforce spends each year on marketing. Because, conceptually, we would hypothesize that if the lion's share of future growth is increasingly driven by consumption, like agentic consumption rather than licenses, then this growth is arguably much less sales and marketing intensive. And so if that's right, then the net result would be a likely continuation of operating margin expansion and significant earnings growth. It could be north of 20% per annum over time. And remember, this business, unlike the hyperscalers and many others, this business has essentially zero capital intensity required to achieve this growth. So if you put this all together, you would end up with a pretty low ratio between today's enterprise value of about 160 billion and the future earnings power of this business. And that's really at the heart of why this company authorized a $50 billion buyback at the beginning of this year, which is a pretty sizable number. So look, one final point on this, I think it's often missed. This view of the world is not like, Salesforce wins and all the AI model companies and all the cloud providers lose. It's not like that at all. Because, in this view of the world, let's say FY30, Salesforce does 63 billion in revenue, and that's their guided number, by the way. We estimate that the AI model companies would pick up, at least 10 billion of that each year as revenue to them. And then the cloud providers would pick up even more. So it's sort of like a win-win in a sense. And it's really, through this lens that Salesforce would essentially be distributing third-party compute and intelligence to the world's enterprises, to actually solve problems and unlock meaningful labor efficiencies. And so we think this is the idea that the market is overlooking today. And this is why, the subtitle of this presentation says it's not about the SaaS. It's just worth noting that we are slowly starting to observe, a slight shift in sentiment, we think, by many of those who have been calling for the death of SaaS. The comment, the quote shown on the screen here is from the famous All In podcast from a few weeks ago. Demonstrates an emerging appreciation for the value of established, large-scale, trusted distribution into the enterprise.
While the market might be pricing Salesforce as though the business is becoming obsolete, the evidence from Agentforce adoption data and on-the-ground insights from customers, as you've just heard, really do point in the other direction. If you'd like to go deeper on Montaka's thinking, head over to the insights section of our website, montaka.com, and if you found this episode useful, feel free to share it with others. Thanks, and see you next time.